Good morning, everybody. I'm Ed Parcaut here on Real Estate Jerky Daily. And Mike Kelly's still, I think he's traveling today. He was in Colorado for a couple days for his granddaughter's birthday. I hope she had a good birthday. How was your weekend? My weekend was pretty busy. We had crab feed on Saturday night. Our Modesto Sunrise Rotary had our annual crab feed, did really well. I'm the president of Modesto Sunrise Rotary this year, and I'm just glad I won't be president during the next crab feed. Not that I did a lot, but it was important to make sure it went off well. And I think everybody had a good old time because I did. And I, want to thank them, but I'll take them on another show. So the number one question that people are looking at is because mortgage rates moved down last week for almost about 0.5%. It just depends on your FICO score where that worked at. So the question is, have mortgage rates peaked? Are we going back the other way? Well, our rates spiked all the way to almost 8.25 in the last month. And so everybody's worried about that. Does this mean that now we've hit the peak and we're going back the other way? If you look at some of I have some little things over here so I don't forget, because when you don't have somebody to bounce thing off of every day, you might forget something. And, Michael, like I said, will be back tomorrow. So I'm sure he's watching right now. So if you look at the 10-year and what it's been doing, it's actually, at the high of 4.93, it actually was over that. It didn't close over that, but it was over that. And it dropped as low as 4.48 in the last, that was on Friday. The question is, what really triggered that drop? Well, there was 3 of the 4 labor reports were softer than expected. We thought, eventually we knew this stuff was going to happen. Job openings were fine, but if you look at it, its potential for going the other way and continuing. And then when Fed came out this last week and said that with their meeting, they changed their words. Basically, they didn't hike rates, but the term that they use, I want to make sure I get it right, is financial conditions and credit conditions now will lead to a lower economic activity in the future. So basically what they're saying is they're seeing already that there's a potential slowdown. We see it, we feel it, remember, all this stuff is in the back window. So it's already happened. We're feeling it, but the numbers don't show until it actually hasn't happened. Before I get into inventory, I want to go over some information about the recession indicators that is out there right now. Yes, I said recession indicators. If you look at unemployment rate from last week, it has risen 0.5% from 3.4% to April of 3.9%. Looking back historically, this is a telling leading indicator. What is a leading indicator? It's going to tell us what's going to happen going forward. And this is a leading indicator of recession. If you go back to the 1970s, which kind of where we're at right now, in the 70s to the 80s, you can see that when there is a rise of 0.5% or more in the expansion low, a recession is already taking place or has taken place for up to 2 months. But it takes up to 2 months for us to figure this out. What does that mean? You got to look very close to this recession indicator and the course leading to a lower inflation and mortgage rate. So basically what we're saying is potentially we're there. It's going to get better. However, I've heard this for the past year. Oh, wait till July, wait till September, wait till October. And now we're in November. I can't believe we're in November already. Well, we got like 55 days left of this year. I tell you, can't wait for this one to be over. So if you look at the 3-month moving average of the unemployment rate that is 0.5% or more than the 3-month moving average of the previous 12 months, it is a scholastic indicator for the unemployment rate. What is a scholastic indicator? It's a way that you can see predicting the trends, reversals, what's going to happen, change. And so what they're saying is that we're starting to see that change. However, it's going to take until like first quarter of 2024 to really know this, because we'll see the numbers in December, but we're not going to see everything right now. So we're going to not really see this number until first part of next year, which is exactly what I thought was going to happen. George decided to come in and see what I was doing. And we're going to see the slower potential Christmas sales, slower, then January, they're going to try to sell everything that didn't sell. It's not going to do so well. And we're going to see by next year that all this stuff that we've been talking about is coming into play. Now let's go to weekly inventory. Our weekly inventory, which is nationwide numbers, went from 562,556 to 566,882. So we went up only 43 4,326, which is about half of what we went up last week. Usually during this period of time, our inventory drops by about that much. I think it has because we only went up a half of what we were going up. But if you look at our numbers, this time last year, we were at 574,000. We're at 566,000. I don't need the change. If you go back to 2015, that number is 1,140,000. So we're at half of what we normally would have at this time. So again, will mortgage rates keep falling? That, again, we're going to depend on what we see. We keep seeing this recession stuff I talked about, they're going to continue to keep falling, but we really don't know. And that's the problem right now. We haven't been in a situation like this for a very long time. People didn't even know what inflation was with the last election. It'd been 42 years since we had it. Now I think everybody kind of understands it, and everybody understands gas prices and what's going on. I just hope everybody makes a good decision going forward. But that's basically what we're looking at. So rates are improved. If you're I think we're on that tipping point right now that people by February wish they would have bought now. I think that's where we're at. I kind of feel that's what I'm seeing out there, and what everybody's saying. We've been saying for the last year to, don't wait for this point to happen. Well, we're there. We're there. So if you're thinking about buying, I would get into contract now, because I think by first of the year, we're going to see a lot more people coming out trying to buy these homes that we just don't have inventory, and we're not going to have inventory for a very long time. And that's pretty much all I have for today. Slow news week this week. It's not going to major changes in the market, but bond market gave back a little bit today. What are we looking at right now? And then I'll get out of here, let you know. We're down 29 basis points, but we were up over 200 basis points in the last week. So that we saw a major change, almost 0.5%. That's a big deal. So so what I would do is I wouldn't wait any longer. I know people are like, it's all you've been saying. I know, but we're really there. That's how I feel. And I'll stick my neck out on that one. Anyway, that's all I have for today. Mike will be back tomorrow. We'll get that back and forth and that funniness, and that he can pick on me like he always does. But anyway, I appreciate you being here. Appreciate everything about him. The most important thing is today, I think that recession indicator again is a backward looking thing. By the time we realize we're in it, we've already been in it for a few months. I think we're there. I feel that we're already there. So that's all I have. I'll talk to you guys tomorrow. Thanks for being here. We really appreciate you. And if you don't catch this at our live at 8:30 in the mornings, you can always jump on the podcast. And that's Real Estate Jerky Daily. And we will talk to you tomorrow. Have a great day.